Hello, everyone. Welcome back to the Three Pockets. A place where we discuss finance, we discuss investment, we discuss business, and we discuss uh, self-development. Okay. And on today's show, I want to discuss three stocks that I think are trading below their values, and this is a great time. You can buy the dip and profit massively as the market continues to recover. So, having said that, let's jump in. The stock market continues to hang in there. Inflation data has been okay, jobs are good, and the economy continues to grow. The US economy continues to grow, and even the global economy, even those in Europe, in the UK, in the Asia market, Japan, South Korea, Australia, um, China, they all continue to grow. But we're still dealing with trade negotiations, which means we're dealing with tariffs along with geopolitical concerns still in the market. Okay, we're not going to we're not going to ignore that because there's still that geopolitical concern in the market. Recently, we just heard about Israel and Iran, but hopefully that that conflict has subsided. Although the market factored that in last week or last 2 weeks and recovered, I heard somebody, Tom Lee, who said that that was a test or a stress test for the market, and the market passed it. Okay, so regardless, the market continues to climb higher, but not all stocks are participating, and a few have sold off. Something I believe has been maybe a mistake for investors. And in today's video, we're going to be doing a lot or taking a look at those three stocks I mentioned earlier that you can buy the dip on and add to your portfolio to profit. After all, isn't the name of the game to buy low and sell high? That is all about investment. That is all about business. The goal is to buy low and sell high. Okay, so you buy the dip and you say high as the market recovers. So make sure you stay tuned throughout the entirety of today's video so you don't miss all of these stocks. And could you do me a favor? I really will appreciate it. It really helped me. It really helps with the growth of this channel by simply clicking that like button and subscribe to the channel, because all of these little actions that you think doesn't really matter, they play a great role in terms of informing the algorithms, YouTube algorithms, that this is a valuable content to push further or to push out to more viewers. So if you could hit that like button and subscribe to the channel, I would greatly appreciate it. Also consider, like I said before, consider subscribing, please. Thanks so very much in advance. Greatly appreciate it. So let's jump back to our video. Okay? Awesome. Again, for those of you who don't know me, my name is Ernest. I'm a CA and MBA. I'm not a financial advisor, so please do your own due diligence, or seek your financial advisor. Do your own research before you invest. I'm not advising you to invest. I'm only giving you tips. I'm only giving you heads up as to what the market is saying and how you can capitalize on that if you want to, with the help of your financial advisor. So let's continue. All right, let's jump back to our video. Beginning with stock number one, which is going to be Okta Incorporated, stock ticker Okta, OCTA. And if you've been listening to me over the past year or so, one of my favorite themes moving forward has been not only AI but also cybersecurity. As myself, I have a business. I have a software development business, and specifically focusing on cybersecurity. So that is a great area that is becoming a boom, an area that I believe can be even larger than AI. Data breaches are happening all the time. In fact, we just had one this week where 16 million passwords were exposed. Cybersecurity is vital to any business. There are many companies focused purely on cybersecurity, such as Palo Alto Network. If you remember, or if you've been following me or watching my videos, you will see that I've talked about Palo Alto in a couple of my videos, that it's a great company. You have CrowdStrike being the two largest in cybersecurity, but even the likes of Microsoft and Cisco have segments that focus on cybersecurity. Even Google acquired a company a few years ago that is mainly cybersecurity. Okta is still an up and coming name. It's not a popular name, along with likes of Zscaler, another cybersecurity name that you may not know, but I like a lot. In terms of market cap, Okta currently trade at $17 billion. Over the past 12 months, shares are up 13% and year to date up 26%. That is no brainer, folks. However, since the stock reached a record high of $127 and changed back in midway, shares have fallen 22%. The question is why? Okay, so what happened the past month? You might ask. Why is the stock falling to 22% from all-time high? Um, you know, I talk a lot about this in my Discord community and also in my in my uh, in my Facebook where I talk to investors as well, which you can check out the link. I mean, I don't have the link here, but if you want, if you're interested to join my Discord community, I think just let me know in the comment below after this segment or after this episode, so that I can send you the link so you can join in those discussions. Okay, so let's roll on. But in there, I will talk about setup heading into earning. Anytime you have a big run up in the stock heading into earning before they even report, that just elevate expectations of investors, expectations of analysts. I mean, looking right here, you can see the stock was up 60% on the year alone, heading into the earning in May. That was just past May, a month ago. They were going to need to not only blow out expectation, but also increase guidance. What happens? Well, the company reported adjusted EPS, earning per share of 86 cents per share, which beats analyst expectation, which is where at least 78% per share. The company reported revenue of $688 million. Analysts from Wall Street or from the market were expecting at least 680.6 million, but they beat the street expectation. So they passed the test, the big test. Now for the guidance, and despite strong numbers, full year guidance remained unchanged, and that gave investors reasons to be concerned, because normally when you beat the street expectation, the market would expect you to change or amend or change or alter your guideline for the remainder of the year. But they didn't do that. Taking a look here at this, if you take a look at the chart, which I'm going to present to you in a little while, you will see that the revenue continued to grow, albeit at a slower pace. But the encouraging thing to me is more around operating income. Since the company inception, they have operated at a net operating losses. But over the course of the past 12 months, what has changed? They are now net profitable from an operating standpoint, which in itself is it's huge and could snowball moving forward. Look at it from another angle, from another perspective. If you check out this physical AI chart here, I'm going to share it to you. You will see what I'm talking about. Uh, this shows free cash flow, and I'll be presenting their financial statement to you so that you can see these numbers. How they jump in a big way the past few years, which is also an encouraging sign. Surely top line revenue are slowing, but the growth in the internal is much more important to me when analyzing the business. Let me now show you, what I mean. A view from a technical perspective. If you look at the trading level, you see that the stock has been trading in an uptrended since last summer. Since summer of last year, it's been doing that, constantly finding support on that lower band. Okay, whereas the stock been finding support the past few days again on that lower band. If you're trading, you see the graph. The other support area right there is the fact that the 200-day moving average is right at $97 per share. Also, moving support for Okta, look up above. If you look up above on the chart, you would see, the RSI is trading in the middle to the lower 30 range, which is also an encouraging sign for both buyers and optional players. The setup is rather solid. Now let's take a peek, at the fundamentals. When it comes to these early stage companies that aren't, that profitable, and if you just start up and you're not profitable yet, generating earnings, we can't focus much on that. You can focus on earnings because they've not. These startups, when they started operations, you don't focus on how much they've generated because they're just on the growth phase. Instead, I prefer to look at a price to sell metrics. And right now, share trade a price to sell of 6.4, well below the company's 5 years average of 18.4. However, the front end, right, like I was saying earlier, when it comes to these early stage companies, you don't focus on revenue. You don't focus on earnings because they've not really, they're just on a growth phase, But let's continue where we're trading at the moment, okay? However, the front end of that 5 years period is a bit skewed. If you look at the chart, I'm going to present to you again. However, now we compare with other close competitors like Polati, CrowdStrike, or Zscaler. And Okta offers the cheapest price to sell of all of them by a wide margin. Taking a look at analyst expectation, their rate is just no brainer. Their rate, the stock moderate buy with an average 12 months price target of 128 per share, providing nearly 30% upside from current level. And that leads us to the stock number 2, which is going to be another company I've spoken a lot in the past, in some of my videos in the past, and this is PayPal. We all know the company. This is a company started by Elon Musk and sold it, for $200 million. Now PayPal is a billion-dollar company, a multi-billion-dollar company with nearly over, the valuation of PayPal is almost getting to 200 to $300 billion, which is no brainer, folks. And so let's look at PayPal Holdings, stock ticker PYPL. It seems like anytime that PayPal finally gets a little bit of momentum going, some news comes out that is not, specifically related to the company, but it's in a general way the financial sector and the stock gets hit. It has happened over and over again. That's exactly what happened the past week. PayPal got hit, and a lot of credit card companies got hit. Visa, American Express, MasterCard, all these companies. This past week, the US Senate passed its stable coin legislation, which was a big win for the crypto market, and it weighed heavily on stocks like Visa, MasterCard, and yes, PayPal. All three of these stocks were down roughly 8% on the week alone. In terms of PayPal, they currently have a market cap of 67 billion. Okay, over the past 12 months, shares are up 17%. However, yet to date, it's been a different story as shares are down nearly 20%, and this is the time to buy them. Okay, there are plenty of reasons to be bullish in that of PayPal. Number two, for starters, we are moving more and more into a cashless society, which is going to, positively impact the likes of credit card companies like Visa, MasterCard, okay, and companies like PayPal as well. In terms of the stablecoin news, PayPal already ahead of that. PayPal is already ahead of that curve. Okay, they are actually creating their own stablecoin that will be pegged to the US dollars, which is quite very interesting. In terms of these, when people just simply hit the panic button and sell stock without understanding the underlines, the news and the impact it has on your specific stock or portfolio, it's time that we want as long-term investors to take advantage of. This is also a stock that I have been utilizing a number of different options on cash secured puts and covered call utilities. Utilizing the wheel strategy, which has been very profitable for us and for me in particular. And again, if you want to follow any of my stock trade strategy and option, and you can comment, and I will share the link with you folks. Whenever, if I can have say 500 people, or say 1,000 people saying yes, we want to see that, 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 then I will share that with all of you so that you can profit as well. And let's move on. Something I love so much from a fresh cash flow perspective. For last year, the company generated PayPal generated record free cash flow, and a free cash flow margin of 21%. Let me now show you the stock from the technical perspective. Which is a graph you see on the screen shortly. Looking here, you can see the stock has found support around the $67 range, which is going to be again a key level, with RSI sitting in the mid 40 cents. Okay, the upside resistance is around 74 per share. Now let's take a peek at the fundamentals. And since 2020, shares have traded at an average, forward PE multiple of 15.3 over time. Okay, today you can pick up shares for just 13 and a half. From an EV, or to EBITDA, earning before interest, tax, and depreciation and amortization perspective, share trade at just 10.8, well below the average of 14.7. When it comes to analysts, they rate the stock a moderate buy with an average 12-month price target of 81 per share, giving more than 15% upside from current level. And that leads us to the stock number 3, which is going to be ASML Holdings. Some of you, if you've been following me, the stock ticker is ASML. If you've been following not just this channel, but the other my channel, the B Stock Pundit, there I discuss about SML. ASML is a Dutch company, and they specialize in lithography of, cheap lithography. That's what they do, okay? And They signed a $7 billion contract with the Chinese government or Chinese companies. So what? And they've been exporting these lithographic machines to China, although less advanced because they've been asked by the U.S. government not to do that, but they've been doing it quietly. When we're talking about AI, everything begins with a machine made by ASML, like I just said. The company is the top producer of lithography machines that are required for all of these high-powered AI chips. And when it comes to the biggest issue around AI right now, it is chip capacity. These manufacturers can't build chip fast enough, and what a lot of them are doing is extending their manufacturing plant. The likes of Taiwan Semiconductors, you know, is building a plant here in the United States that is going to be filled with ASML machines. The company currently has a market cap of 300 billion, but I'm sure that 300 billion market cap is going to increase in the next 2 3 years. This company, I can guarantee you, will be valued at over $1 trillion in the next 2 years or 3 years. The largest company on this list today, okay? But over the past 12 months, shares are down 28%, and yet to date, they are up 9%. There is a few concern when it comes to investing in ASML, you know, and the first is a slowdown in AI spending, which has been talked a lot but hasn't really come to fruition. When you look at many different financials and capex expended budget, the second thought is going to be geopolitical concern, because this is a company that over the years has generated a lot of revenue from the likes of China, like I said before. And right now, there is a lot of trade tension between the US and China. However, the company has done a nice job reducing its exposure. Again, this is a company with a very wide moat in a space that is only going to continue to grow. And along with many other factors, it is why I recently added it to my personal portfolio, because having analyzed them, I've lived in the Netherlands myself, so I know the company. I know where they're situated in the Netherlands, and I know the country very well, and I know what they're good at, and that is why it has been. I just added on my list. And if you're interested in the stocks within my portfolio, like I said before, if I can have 1,000 people saying yes, we want to see a portfolio or interested to see uh, my trading portfolio, I'm willing to share it with you folks. But there have to be at least 1,000 folks, 1,000 people, you know, who want to see it. Okay. So looking at revenue for ASML in the past 10 years, you can see the revenue has been growing consistently. But more importantly, I love to see margin even more, which are currently sitting at 34%. From an operating margin perspective, from a fresh cash flow perspective, look at not just the explosion in free cash flow, but look at, I mean, free cash flow margin. What are those margin for? You have to look at the margin, folks, which are now worth of 30%. I mean, that is in itself is incredible. Now take a peek at the fundamentals. We're going to take a look at the fundamentals. Over the past 5 years, shares have traded at an average PE multiple of 34 and a half times. Today, you can pick them up for 28 and a half times, and earnings are expected to grow more than 30% this year alone, given the company's PEG ratio below 1. From an EV to earning before interest, tax, depreciation, and amortization perspective, shares trade at just 22.2 times, well below their 5 years average of 33.3 times. From the analyst's viewpoint or perspective, they rate the stock a moderate buy with an average 12-month price target of 870 per share, implying 15% upside from the current level. So, there we just looked at the three completely different names in the market. Okay, looking at the cybersecurity company, looking at PayPal, then look at ASML. All different companies that can all find place in your portfolio, and I believe are trading at great valuation. So now I turn the table to you, folks. Let me know in the comment below which of these stocks or which of these three stocks do you like best or do you like most? And which stock do you claim to be a great buy at the current level? If it is not in this list, let me know down in the comment, okay? I will try to read all of your comments, but just to say in advance, thank you so very much again for watching this video. Greatly appreciate it. And if you haven't done so, please, I implore you to show your appreciation, and your love, you know what I mean, by simply clicking that like button below and subscribe to the channel. And until next time, take good care of yourself and each other. God loves you, and so do I. Take care of yourself. Bye-bye for now.